Good evening. You're watching Stock Watch with me, Zinati Kuma, and joining me to unpack your stock-related questions tonight are Gary Booysen from Ransus and Nader from Benguela Global Fund Managers. Be sure to send those questions via SMS to 41392, email us at stockwatch@bdtv.co.za or tweet us at businessdaytv using the hashtag StockWatch. Thank you so much for your time, gents. I'm actually going to go straight into the questions because there are a lot of them today. Let's actually start off with Nvidia, of course, one of the big ones that markets were waiting for, which came out yesterday. So the viewer says, I bought Nvidia before the results and noticed it going down. I'll keep them as I'm sure they will go up, but I'd like someone from the panel to tell me why they do not pay dividends. I'm sure this is why there is no more upside on the stock. What is the point of having $80 billion in the bank and not giving it to shareholders? Okay, so quite a lot to unpack there. Let's start off with why are they not paying dividends, Gary?
Well, they're not paying dividends because they're a growth stock, and they're growing aggressively. As we can see, they tripled their revenue, and typically a growth stock, I mean, they're looking to expand the business, so it's more assets, it's more business. It's not I don't think Nvidia is anywhere near hitting kind of like that saturation point that you find in the high dividend paying stocks. So yeah, it's I suppose the typical nature of a growth company not to pay a dividend because they want to expand, and that's I think what everyone's buying it. It's why it's in terms of its sales figures. If you look at price to sales, it's the most expensive stock on the S&P 500 by almost double. I think MSCI is the next most expensive in terms of revenue, and it's because you're paying up for all that revenue, and to get all that revenue, you got to spend money, even if it's in your bank account. They're going to invest.
Yeah, Gary, I'm glad that you touched on that saturation point that doesn't seem visible at this point, because the viewer says, I'm sure this is why there is no more upside to the stock. Those are not the signs that the markets are showing, right, Grant?
Absolutely. I think if you don't think there's any more upside, then you should rather take your profits if you've been holding it.
Yeah.
I think this is a stock with a very long story ahead of it. It's arguable whether you're paying the right price. I don't know at this point, but certainly the growth opportunity is still massive. I think we're in the early stages of the evolution of AI, self-driving, data center growth, etc. There's a lot of things happening that they are at the epicenter of. And so, yeah, I don't think the company's ex-growth, as Gary said, that's why they like to stockpile cash. And there's also a trend among these tech companies. They don't want to commit to paying dividends. They'll rather, buy back shares if they feel they've got too much cash. Then they're not committed next year to buying back another 10 billion. That becomes a voluntary thing. So they have more freedom of choice around their cash than having a dividend policy that says we'll pay X every year. And that sort of pigeonholes them. They don't like that.
All right. Well, let's bring it back home to retailer Mr. Price. It did come out with its results today. View on Mr. Price as a buy. Of course, we did see a lot of buying today. And I actually just want to know, Gary, I mean, what did markets hold on to here? Because, I mean, obviously they had that strong revenue growth, but then they were like, if it wasn't for Studio 88, it would have been 3.5% growth. And also headline earnings did decline. So exactly what were markets banking on today?
Well, I think it's less bad than people were thinking it was going to be. So as you said, the top line was obviously boosted by the Studio 88 acquisition, but we already had a trading statement, giving us fairly detailed outlook. So it's interesting that the market reacted as aggressively as it was today, because as I said, we knew a lot of the information. I didn't pick up anything that was particularly strange within the company, at least within the results that kind of propelled the stock up as much as it is. And I think there's a couple of things to the story. So I actually put out Mr. Price as a JSE stock pick. I think it was on the 1st of November at around 137 Rand a share. And the thesis behind it was that they've had a terrible period. I mean, load shedding has absolutely crushed them. They haven't been as nimble as some of the other retailers. Consumers are hurting, specifically, in kind of that fashion, even fashion value. It's typically a higher LSM type product, and their omni-channel kind of presence. It's tough out there. There's huge competition in that segment. Not just from the listed players, like Foschini or Truworths, but from international competitors as well. And at the same time, they import a lot of their goods as well. So a weaker currency is also bad for them. So it's a terrible place to be. The question is that the valuation is incredibly cheap. You're getting this like a very well-run business, that has a long track record at kind of 11 times earnings. Like you'll pay 20 times earnings for ShopRite, but only 11 times for Mr. Price. Now, if your view kind of a couple of years out is that interest rates are going to fall, we obviously had the MPC announcement today, unchanged from the governor. But if interest rates are going to fall and things are going to get a little bit better, there could be significant upside in the stock. I mean, it's been absolutely punished. So for me, it was just people looking at the valuation saying, wait a minute, it's diversifying its business with Studio 88. Yes, it is buying up, obviously, those top line sales, but overall, not as bad as we expected from a tough period. And that's why they're buying it up. That's what I saw anyway.
Yeah. Yeah, I mean, that Studio 88, a good acquisition, but it seems tricky because they also said it also operates on lower margins, and also its earnings are more weighted towards the second half of the year. Grant, what did you make of those numbers? But also, would you be viewing Mr. Price as a buy or not?
So I think they were also, I agree, they were less bad. And I think some of the market's response is a function of market positioning. I think a lot of hedge funds and other players have been short the retailers into this gloomy economic outlook. And that often happens where you get things just start to look a little better. And as Gary said, if you take a 12, 18-month view, things are more likely to be better a year from now than where we are now. And if you believe that, these stocks are presenting value, these cyclical discretionary players. And so I agree that it makes sense to be nibbling at these attractive valuations. I don't think the results were particularly good. I think they're going to continue to struggle with market share and with margin. But again, a rising tide will lift all boats when it comes to these retailers as things improve on the macro. And I think rates have peaked, and so that will favor them. So, yeah, I mean, I think they're in a tough space. The Studio 88 did color the painting a little prettier than it would have been otherwise. So, yeah, I think you can buy Mr. Price here. I would be quite tactical about it. Perhaps, the time to buy it was in the 130s. It's had a nice run now, so perhaps be just a little careful of some of the short covering, pushing the price in the short term.
And I was actually just looking at Truworths because TFG came out, Mr. Price came out, and investors reacted quite positively. But we did have, when Truworths came out with its update, markets didn't quite like it. But as you said, Grant, a high tide lifts all boats, because I do see Truworths up today by about 4%. Let's move on to other questions. Panel's view on SA REITs with a potential drop in interest rates in the near future. Of course, Gary, you were talking about the expectation of interest rate cuts, the impact that would have on retailers. Would you say, the same sentiment for SA REITs?
Yeah, I think the same mechanics are at play there. So, REITs are interesting. I think you need to be quite selective on which REITs you're going to buy into. I think there has been a structural change within office specifically. As much as I think more and more people are heading back to the office, and you're getting the sense that it's becoming that new normal that we're all talking about is kind of going back to the old normal. But we're still sitting here on a Zoom call today. This is still digitally. We're not in studio, and I think there has still, even with the kind of changes that we've seen maybe over the last year, I think office you need to be a little bit more careful of. But in terms of retail or industrial, absolutely, lower interest rates, it makes the economy that much more attractive. It makes projects, the weighted average cost of capital drops, so projects become viable, businesses start booming, businesses hire more people have more discretionary income, they go and spend, shops are busier, the economy expands, and I think that's that's very much an argument for REITs. A lot of the South African REITs also have wonderful international exposure as well. So you're not limited to the South African economy, where we have an energy crisis that will curtail growth. And I think that's the lens that you've got to look at South African, or at least South African listed property REITs through. Is yes, South Africa is difficult, and like as you guys know, I've kind of followed and invested in storage for years and years and years, because it's a very interesting speciality REIT that does well in difficult economic times. But I think also just be aware that when you're investing in property, yes, lower interest rates are going to help, but it also is a function of what people can pay in terms of rentals as well. So it's not just that interest rates are lower. Hey, this is a comparable product to bonds with lower interest rates. Bonds have risen. We're not getting the yield. Hey, let's go buy property, because you need tenants. You need tenants that can pay as well. So be aware of the kind of asset that you're buying into.
Yeah. Just talking about us going back to the old normal, maybe landlords also need to thank load shedding. I'm just trying to look at the glass half full here. Grant, SA REITs, Growth Point also did come out with an update. When was it? Yesterday, 2 days ago. Green shoots, of course, but there's still like this cautiousness that all these property companies are coming out with. Would you be getting into them or not at this point?
I think if your risk appetite is a little bit lower than, say, buying a discretionary retailer, Mr. Price, the REITs are not a bad place. You get a nice yield and a bit of a capital appreciation. Potentially your total return outlook is actually quite nice. But bear in mind, as Gary said, you have to be careful in which sector you're playing. Some have been slow to recover. Retail has held up very well. Industrial's been pretty good, but office has been terrible. So there's a lot of supply and demand dynamics under the surface. Rental reversions there's still a lot of pressure around trying to pass on increases in rental. So I think it's a safe play. It's not going to give you the best upside exposure to a recovering outlook in South Africa, but they'll benefit if load shedding eases. They'll benefit from falling rates and a generally better economic outlook. So I think you'll be okay there if you just buy the qualities, stick to the quality.
Before we go into break, Ford Motor Company, Ford analysis, is it a good buy, Gary?
Oh, starting with me on Ford. Ford's a difficult one. So if you look at I suppose the big Detroit car manufacturers, I mean, their lunch has been eaten by someone like Tesla from a shareholder point of view. Everyone is bought into the EV story, and it's a difficult question, because for a long time I was quite pro, specifically when markets were running hard pre-COVID and everything started to look very, very expensive. I mean, that's actually the point at which, we picked up a little bit of Ford for some clients, but our kind of model portfolio pick was actually General Motors at that stage, saying that this thing is trading on, yes, you're not really expecting growth, but it's just trading on an incredibly low multiple compared to something like a Tesla. So that was the thesis: bring a little bit of stability to the portfolio, build a margin of safety. It has been an absolutely appalling pick, and I think that the reason that it has been such a poor pick as well is that this industry. So if you look at the automotive industry, it is incredibly competitive, and part of the thesis was that Ford, GM, VW, these might be very cheap, and let's say the European auto manufacturers have done a lot better. If you look at BMW, VW, they've done a lot better than the US manufacturers. But the idea was these companies, they have a huge amount of money to spend on technology. They are going to move towards an electric vehicle future, and to see them as the old stagnant dinosaurs and Tesla as the new one, it doesn't gel. It doesn't make sense. So buy the cheaper one, sell the more expensive one. As I said, it hasn't worked out at all, and I think that the problem is that the fleet of vehicles in the world is almost stagnant. You might be switching from a petrol car to an electric car, but you're not producing 3 times the number of cars. So the growth is going to be quite subdued. And I think that's one of the reasons that they just haven't performed, and that even with incredibly attractive multiples. So I'm looking at Ford at the moment. I mean, Ford is trading at 6.7, based on last 12 months earnings. I mean, that that is cheap. It is just so cheap. I mean, if you look at even the sell side consensus for the stock price move, I mean, you've got plenty of analyst coverage, because you always do on a US stock like this, which is so wonderful. It keeps the pricing so accurate. You've got such good price discovery. I mean, they're looking for at least 28% upside from here. But the point is, over the last 3 to 5 years, you just haven't received anything as a shareholder. It's been really a difficult ride. So a difficult question, and I'm still sitting. I haven't given you an answer whether you should go and buy it or not, but because I really don't know. I mean, I think that there's real concerns around them not being able to perform, but they're cheap, man. It's dirt cheap stuff.
Okay. All right. Grant, I'm going to come to you with Sibanye, but quickly, Gary's already given us a lot of analysis on Ford, but the question is it a buy? He did say it's cheap. Would you be buying it or not?
No, I wouldn't buy it. It's a value trap. They can't invest. They have to invest all of their profit into building out EVs, or so shareholders won't get any return from that. And EVs are a much lower return profile in terms of profitability for them, because they're not anywhere near the production level they need to drive the scale. So I just think that there are just too many challenges, and they're facing that kind of innovator's dilemma, whether to cannibalize their own profitable business and eventually hoping they'll be profitable in a new business. So no, I think it is cheap, but I think it will stay cheap.
Yeah.
So I wouldn't buy Ford.
All right. Sibanye, we have seen a lot of dumping on Sibanye. And of course, it was after they announced that they will be issuing convertible bonds. Somebody is saying, I'm aware of the planned convertible bond, but can your panel please explain the technical aspect of the drop in Sibanye's share price? So how does the conversion price at a 30% premium impact the number of shares to be issued? Grant.
So it's unclear whether this is what's happened, but what typically happens with convertible issues is you get arbitrages. So convertible debt arbitrages, they will subscribe for a big chunk of the debt, and in that debt, in that convertible element, is an embedded call option on the company, and so they basically try and extract value out of that call that they see, and doing so they need to hedge that exposure. And I don't want to get too technical, but essentially their hedge is to sell shares. So if I buy that convertible bond and I don't want the share exposure, I will sell short on those Sibanye shares. And if you think about the issue of $500 million, it's about 8 or 9 billion rand. And if you had to hedge it, half of that, for example, would be a significant number of shares, 4.5 billion, which is typically what you would hedge per rand on that option. So I think there's a lot of market mechanics in that big sell-off, is the first thing I want to say. And we won't get more technical than that. So it could be a bit misleading. Obviously, it did raise a few eyebrows and maybe make people a bit concerned about the prospects. What do they see that we don't see, that they're so concerned about, that they feel the need to raise so much cash? That's a concern. It was quite dilutionary in terms of pricing. It's not like they're issuing at the top of the cycle. So that's another concern. And also, what are they going to spend the money on? Their recent track record of acquisitions hasn't been particularly good. I feel like they're rushing into everything they can lay their hands on in a bid to diversify into green metals and alternate sources of, whether it's lithium or other things. So it feels a little bit haphazard, a lot of money getting thrown at the wall. I don't have comfort that the ship is being steered carefully at the moment. And if I was going to play PGMs, I would rather look at a much higher quality business like Amplats or Implats at this point.
Yeah.
So it's possible the share price recovers to some extent because of those dynamics that may need to wash through the system, but I can't say for sure.
Yeah. Gary, are investors most nervous about the dilutive element, but also with this pressure, could it be a buy?
It's a good question. So yes, I mean, I think Grant has explained it, the kind of market mechanics side of it well. But at the same time, when you issue convertible bonds, you would expect a dilution down the line, and market participants, in size are also not not dumb. So they can calculate the dilution, the potential dilutionary impact, and it'll change your price expectation significantly. And suddenly you might have been willing to buy it at 24 Rand a share, but now you're only willing to buy it 19, and the price automatically drops. It doesn't necessarily have to be those sells coming through the market, but I mean the dilution, yeah, absolutely. I think it is a concern for investors. And just to Grant's point, I think you've got to understand what you're buying when you buy a Sibanye as well. So it's certainly not for widows and orphans, as they say. It's a highly speculative stock, as most commodity mining companies are, specifically commodity miners that are exposed to a specific metal group. So when PGMs are doing well, of course Sibanye could do no wrong. The share price is going to shoot up. You need to think back to something like Benguela. I mean, when coal prices are flying because there's an external event like a war in the Ukraine, suddenly the share price is doubling and tripling and quadrupling. But the same happens in reverse when prices fall. And I mean, I take Grant's point that it does look like they're doing a lot of deals. But I mean, this has always been the type of company that is not afraid to go and do deals. And they did incredible deals at the bottom of the platinum market. And I think time will tell whether the move towards these green metals and the battery metals, prove Neil Froneman and the team to be exceptional deal makers or just cowboys that got burnt. And they've pulled it off before. I mean, if you think of what happened when they did the Stillwater transaction, everyone was critical of that. Too much debt, way too much debt, never going to pay that down. And did they get lucky that the platinum cycle turned? Maybe, but I think Grant is 100% right. It's a high risk company that you're investing in, and you're going to have high volatility on the back of it but it's the same as what you would expect with any commodity company. So I think your question was, is it a buy at these levels?
Yes.
I think you can nibble, but it's a buy for a certain profile of investor. I don't think Grant is talking about how you could go and buy property REITs and you're not going to shoot the lights out because it's a stable, more safer type of investment. This is at the other side of the spectrum. If you see metal prices going up, you're going to get the operating leverage moving through the business. All of that profit is going to drop to the bottom line, and you're going to suddenly be looking at a share price 3 times what it is today. But there's also a very real possibility that you're looking at half or a third of your money. So, take it where it comes from.
Maybe more of a trade than a buy.
Oh, okay. All right. I hear you there. Well, still sticking to commodities, Glencore. I'm thinking of buying Glencore for a long-term investment, also with the hope that once their coal business has been unbundled out of Glencore in about 2 years' time, it would hopefully create shareholder value similar to when Anglo unbundled Thungela. Grant, do you get in hoping for this whole value unlock in 2 years' time?
I think if you want to be invested in resources, you can own Glencore even without the thinking of 2 years value unlock in 2 years' time, because this is a very astute management team. When they do deals, they usually do them at the right price and in the right areas. And I think they've got a good track record, less cowboy-like, some cowboy elements, but they really have a good long track record of doing the right things. It's a solid business with a good portfolio of metals. I mean, I think Glencore is a good business. I think you can own it anyway, and they do have a big focus on shareholder value creation. So I think you will see value unlock in a couple of years' time as a consequence of this deal. And so, I would be a comfortable holder of Glencore. Probably my second pick in the resources space.
Interesting. Gary, on your side, would you be going into Glencore or not?
Yes, we hold Glencore in our local model portfolios. So absolutely, I think Grant is right. I mean, a good track record, a little bit different from some of the other diversified miners, as they got the marketing arm as well. And definitely. I mean, there's obviously a change in the management. So Ivan Glazenberg, who's been there forever, is obviously handing over the reins. And I think that maybe adds a small element of risk. But this is a big multinational resource company. And I think for South African investors or investors that are, accessing the market through a local exchange, let's say that you're buying something within a Reg 28 product. We are so fortunate in South Africa on our exchange to have exposure to incredible mining companies. You don't need to go to Australia or London to buy these. You can buy them right here at home. And I think Glencore being listed on our market is fantastic and definitely worth having in portfolios. It also, to an extent, acts as a rand hedge as well. So should be, I would say, in a diversified portfolio, Glencore should be a component.
All right. Well, gents, let's get to your stock picks for today. We have a minute between the two of you. So, Grant, what will it be today?
So I'm building on the view, the improving outlook in South Africa, a little more optimistic with a 12-month outlook. I like AVI. I think it's proved incredibly resilient in holding on to its margins through this really tough cycle. We've seen it outperform all the other food producers. And I think as food inflation drops off, they're going to recapture some of their old margin. As people have a bit more confidence, maybe a bit more money in the pocket, they will shop up a little bit back to some of the more luxury brands or the more sort of higher LSM brands that AVI has. And in the meantime, you're getting paid a 7% dividend yield. We're looking forward at a company that's really one of the highest quality businesses on the exchange at a decent valuation. And it's just a nice sleep at night, capture some of the optimism that may play out over the next 6 to 12 months. And if it doesn't, you'll still be fine. So that's my pick.
All right. Gary, quickly on your side, your stock pick?
No, I'm going for... My research team is going to hate me for this one because we were debating it at length this morning. But yeah, I'm going to go with growth points. I'm going to kind of build on our theme that we're talking about today about, almost the safer property option. It's typically a bellwether of the South African, well, I suppose, of the South African listed environment. It's not necessarily just South African. So, about 62% of its assets sit within South Africa, 30% in Australia, about 8.5% in the UK. So you do have that kind of spread. It does have obviously an office component as well within the portfolio, but kind of looking at consensus estimates, I mean, we're looking for at least sort of 12 or 13% upside over the next year, and it also comes with a chunky kind of 12% forecast distribution. So that's reasonable. That's above what you can expect from the market on average, and I think in a falling interest rate environment that we could potentially have over the next 3 years, I think that it will. I think you're going to do well with it, and as Grant said earlier in the show, it's these property REITs are maybe a safer option than some of the others. So I'll play it safe today and go with growth point.
All right. Well, thank you so much for your time and for your analysis today, gents. Really, really appreciate it. That is all for Stockwatch this evening. Thanks to our guest, Gary Booysen from Ransus and Grant Nader from Benguela Global Fund Managers. Coming up next, The Close. Stay with us.